The Australian property market on the brink of collapse.
It's just ridiculous. We're in a bust phase. The interest rates have gone up. People can't handle their cash flows. So let's have a look at a recent article going through some of the data, talking about the Australian property market and what's playing out at this point in time. The Australian property market could crash with one move. There's only one thing keeping house prices more buoyant than they possibly should be, but that could all be about to change. Wow, I'm very intrigued. Since the pandemic first arrived on Australia's shores back in 2020, the housing market has experienced quite a rollercoaster ride. At first, it experienced a significant fall as uncertainty mounted over how the pandemic would impact the economy and the way we live our lives. Now, I don't know about a significant fall. I bought property in April 2020, which was really 2 months into the pandemic. And there were definitely less buyers in the market, but we didn't see prices pull back 20% or 30% or 50% like people have spoken about over the decades gone by in terms of doom and gloom in the property market. We might have gotten, I think we got about $6,000 off the asking price for the Baby Queenslander. So they were asking $550 and we ended up purchasing for $544. But we were able to renovate the property on weeknights and weekends while working during the day. And so that's how we were able to fast track our journey. I didn't see a 20% drop off, which would have enabled us to buy the property for $450,000, but we were quite happy to buy at that time because we were planning to hold property over the long term. As 2020 headed towards its close, the course of the market changed dramatically. With demand juiced by superannuation withdrawals, the lowest interest rates in Australian history, and cheap fixed interest rate loans, the RBA providing $188 billion in extremely cheap funding to the banks, housing prices began to recover. By the time 2021 was a few months in, the largest and arguably most broad-based housing price boom in Australian history was underway. But like all good roller coasters, there was another big drop to come. By March 2022, housing prices in Sydney and Melbourne had begun falling, albeit at a rather pedestrian pace. I really think this rhetoric is interesting. It's just talking about the money supply from the Australian government. There was a lot of money supply and everyone had cash to splash, essentially, and go out there and buy an investment property, buy their beach home, upgrade their house, do some renovations. So there was demand across the board, which meant everyone's in jobs, everyone's working, and everyone's building up all this cash. Now, what the RBA is doing is constricting the supply due to raising those interest rates because the spending has been out of control and property and assets have grown significantly over the last few years. Now, with this tightening of credit, we're seeing less availability to cash. This means people need to be more selective with the assets they buy. And so assets that are in poor locations or on main roads, thoroughfares, right out the front of schools, in lackluster areas essentially, have seen greater pullbacks than other properties located in quiet streets with strong yields on large land parcels. This is part of the natural property cycles and part of Australia's economy, the natural cycles that Australia's economy goes through. The RBA reacts to what's happening with inflation and tries to grow the economy when Australia's going through tougher times and constrict the economy when prices are getting out of control, especially in terms of everyday goods that consumers use. So how fast are prices falling? This is the crash that everyone's talking about. At first glance, this seems like a rather simple question, but it actually depends on who you ask. A lot of different data providers, PropTrack, CoreLogic. PropTrack has said capital city house prices have fallen 5.49% from their peak, with Sydney leading the way down by 7.23%. However, CoreLogic, they're saying housing prices are down across all capital cities. And this is because we don't have a consensus on the data sets that these guys provide. At a 5 capital city aggregate level, which covers Sydney, Melbourne, Adelaide, Brisbane, and Perth, home prices are down 10% from their peak. Sydney has led the nation down with prices falling around 14%, with Perth proving the most resilient, down just 1% from its peak. And I think that's really interesting. WA has had a tough time over the last 20 years with the mining collapse in the 2010s. And so I think Perth is coming back because the resources sector is doing quite well. And there are some affordable price properties in Perth. That is a big driver for demand, especially with interest rate rising. Where can you get more affordable property? Now, Adelaide also has seen major growth through the last 2 years, and Brisbane has also seen a lot of growth in the last few years. But those locations are relatively affordable compared to the Sydney and Melbourne average prices or median prices. I know for a fact a lot of our clients like to buy between the $400K and $1 million mark here in Southeast Queensland, and it's the same in Adelaide and Perth. There's opportunities to buy between $500,000 to $1 million, get a reasonable cash flow depending on the price point you buy. Generally, a lower price point will have a higher yield and a higher purchase price will have have a lower yield because the yield's getting compressed as you pay more for the land. So I think it's really interesting when they talk about these locations, Sydney, Melbourne, Brisbane, Adelaide, and Perth, that of course these potential falls have, say on average 10%, are spread across an entire city. You need to really narrow down onto the street. You need to really narrow down to the suburb and focus on your investment property or your potential investment purchase or your own home if you're looking at your home as an investment as well, to work out what the movement in property prices are at this point in time and plan for the long term. Don't make a decision for the next 1 to 2 years. You need to have a long-term strategy, but also try and time the short and mid-term market as part of that long-term strategy. To elaborate a little further on that short-term versus long-term timing, you may want to build your cash buffers until you're at a point where you're very comfortable to buy in the market in the next 1 to 2 years. Or you might want to be aggressive and try and get significant discounts on properties where you see that the vendors are distressed or the property needs significant renovations. Properties that require work at this point in time aren't selling for a premium. We've seen suburbs, for example, on the north side of Brisbane, around 15Ks from the city, where you've been able to buy a property for around 700K, but the median price point for a house in that suburb is around 900K for a renovated property. So unrenovated 700K, renovated 900K. So if you can manage a renovation for 100 grand, you could potentially create $100,000 worth of equity in that situation. How Aussie property has changed. In the various market cycles the Australian property market has experienced over the decades, conditions have been vastly different by the way they stand today, or even the way they were during the boom times seen during the pandemic. In late 2021, the housing turnover as a percentage of total housing stock surged by 6.2%. The highest level since the Rudd government first home buyer grant boosted activity in the late 2000s. And this is the graph here. So you can see 2010 out to 2022, and you can see the peak here at 6.2% up in terms of the annual turnover rate. And now we've just dropped below the decade average of 5.2%, down to around 4.9% in terms of the turnover. So properties turning over less at this point in time. And this is, that supports what we're seeing on the ground in terms of sellers who don't need to sell or don't want to sell, don't want to cash out, are happily sitting on their property and will hold out for a later date to make a sale. With interest rates now rising and pandemic-driven demand flagging, the market appears to be heading for a very different set of conditions where turnover and new listings are far lower. While it may not seem like it, low listing volumes are actually doing a great deal supporting house prices. Currently, the total number of capital city homes listed for sale is 19% below the 5-year average, down well over 40% from the level seen during the last housing downturn in 2018. That makes sense to me. If you're going to see a fall in stock on market, property is a game of supply and demand. So if we've seen the supply significantly reduce and the demand has also fallen off, but they're still comparable, that's where you're not going to see major price declines. If the supply comes down in the market as well as the demand pulls down, you're not going to see a massive 20% crash in property prices. People are going to hold on. In terms of property investments, it's an expensive asset to get into, especially with the stamp duty and all the fees you have to pay to buy a property. And it's also expensive to exit a property. You've got to pay capital gains tax. And you generally only get a 50% concession if you've held the property for over 1 year. So in those circumstances, because it's difficult to get in and because you've got to pay a couple of percentage points to get out of a property, people generally will sit on their hands and sit on that property for a longer period of time if the market does pull back and soften a little bit. So let's close this out by what I'm sure we're all interested in is what's going to happen going forward. Where's the crystal ball gazing in terms of the property market? So with a standoff between prospective home buyers and prospective home sellers, rising rates and the conclusion of fixed interest rate loans, this is the cliff everyone's been talking about, driving borrowers onto more expensive variable rates, this could potentially change our situation. According to the data from the RBA, 14.6% of borrowers face negative spare cash flow if the cash rate is raised one more time to 3.6%. In recent days, more and more analysts have raised their forecast for the peak of the cash rate, with one analyst raising the possibility of a 4.85% cash rate by August. Now, I think that's a bit ridiculous. I don't see the cash rate going to 4.85% by August. I think we're more likely to reach a low 4% in terms of the cash rate, which means the everyday Aussie on a variable loan will be somewhere between 6 to 7%. Now, that is not cheap by any means, especially with the higher levels of debt that Australians are carrying. but that's why you need to find the balance of cash flow and growth when building a property portfolio. While it will be quite a long time before a larger number of borrowers could find themselves in truly dire straits, we could begin to see pressure build on households struggling with higher rates in the coming months to reconsider their position and explore the possibility of selling their home. On the other hand, the longer low listing volumes persist, the longer the market will be offered this strong degree of support in balancing out the sizable drop in demand driven by higher rates. Now, what do you think is going to happen? It's really interesting seeing this play out in terms of the supply and demand situation, as well as people forecasting what the RBA is going to do. I don't think you can rely on these analysts. The banks are generally wrong. People are just guessing as to what might happen in the property market. For me, I think it is likely that we will reach somewhere in the low 4% for a cash rate this year, and that's what a lot of Australians are probably thinking. I see the property market probably having those rate rises between now and June. The rate rise is stopping for a short period of time, say 3 to 6 months, and then we might see some cuts later in the year. What this might mean for property prices is if the supply stays low, we'll see property prices continue to soften, but not drop away drastically. As soon as we see that cash rate steady, I don't think we're going to see a boom. I don't think that once the cash rate stops rising, people will see a massive increase in demand for property prices because the interest rates are higher. What I do think will happen is that demand for really good stock that yields well and has good growth potential and has the right value add opportunity, that stock will go in significant demand. And that's where people will be looking to the next major cycle rather than focusing on this minor cycle. I think the next major cycle will happen in the next 3 to 5 years, especially in Southeast Queensland. And that's why I run a Brisbane-based buyers agency. I'm very bullish on the Southeast Queensland market, the infrastructure, the spending, the long-term growth potential, especially with the Olympic Games as a bonus. And so I think what will happen is people will start picking up assets once the interest rates stabilize and people can map out their cash flows. There are going to be people who struggle, and that is a sad situation, but that's why you need to manage your cash flows and take calculated risks. That's essentially what we're all doing at the end of the day. We're using the knowledge that we have available. We're looking at these articles. We're looking at what the economists are saying. We're looking at what the research tells us and historical trends in terms of property prices and growth, and we're then making an informed decision. You need to look at both the quantitative and the qualitative data to make an investment decision. Now, I run a Brisbane-based buyers agency, so of course take what I say about Southeast Queensland with a grain of salt. But if you're interested in the Southeast Queensland market and you want to potentially work with us as a Brisbane buyers agent, head over to purposeproperty.com.au to book in a free strategy session with myself. We're going to sit down, have a chat about the current market, have a chat about your situation, your short, your long-term goals, and what we do as buyers agents buying here in the Brisbane market. Otherwise, if you're interested in hearing me chat more about the RBA and interest rate rises that we've seen in recent times, click this video over here. Thanks for sticking around. I'll see you in the next one. Peace.